Welcome to Iron Financial. We're here to help you forge a stronger portfolio, and we do that by cutting through the market noise, the hype, and getting to the unvarnished truth. Today, we are putting Hormel Foods directly under the microscope. The company just dropped its Q1 earnings report, and if you just read the headlines, you'd think everything is rock solid. But our job is to put that claim to the test. We're going to stress test this company's entire structure, from the foundation right up to the rooftop, to see if it's truly built to last or if it's just a house of cards waiting for a stiff breeze. So, let's get into it.
Okay, so here's the setup. On February 26th, Hormel put out its first quarter numbers for the 2026 fiscal year. Now, at first glance, things look pretty good. The big number they're touting is that this is their fifth straight quarter of organic net sales growth. You know, in a market like this that absolutely punishes any sign of weakness, seeing 5 consecutive quarters of growth in anything is going to turn heads. It suggests there's real momentum here, maybe a core strength that they can build on. This is exactly the kind of data point that gets the bulls all excited about the fundamental health of the business.
And here it is, the official line, straight from the top. The interim CEO, Jeff Ettinger, is calling the results solid, and he's pointing right back to that organic growth and what he calls disciplined execution. This is the narrative, the story that the company is actively pushing out to the market. We're stable, we're strong, and our protein-focused portfolio is winning. You know, they're really painting this picture of a well-captained ship that's skillfully navigating some pretty choppy economic waters. But as always, our job is to look underneath that fresh coat of paint and check for rust.
So that brings us to the big question, doesn't it? Are these really solid results? Are we looking at real structural integrity here? Or are we just looking at some brand new drywall that's been put up to cover some deep cracks in the foundation? Look, every company is going to talk up its wins. That's just part of the game. But the market, it doesn't pay for talk, it pays for performance. The real story is never, ever just in the headline. It's buried in the footnotes, it's in the segment breakdowns, and it's hidden in the forward guidance. That's where you find the truth, and that is exactly what we are here to uncover today.
So here's our blueprint for today's analysis, how we're going to break this all down. First, we're going to inspect the big headline numbers. That's the EPS and the revenue. Then we'll break down the company's core structure, looking at it segment by segment to figure out which pillars are actually load-bearing and which ones are starting to buckle. After that, we'll take a look at how they're trying to trim the fat with some strategic sales. Then, we will scrutinize their forward guidance. And finally, we will deliver the iron verdict. Is Hormel a real opportunity to strengthen your portfolio, or is it a dangerous trap?
All right, let's get the tools out and start right at the bottom, with the foundation, the headline numbers. This is the first layer of our stress test. Did the company meet expectations? Did they beat them, or did they miss them? This tells us a lot about how well management is navigating the current environment, and frankly, whether they're keeping their promises to Wall Street. Let's begin with the bottom line.
Okay, so right off the bat, this is a clear win for Hormel. Adjusted earnings per share, or EPS, came in at 34 cents. The consensus on the street was for 32 cents. This is the kind of heavy lifting that investors really want to see. It means the company is managing its costs and its operations effectively enough to squeeze out more profit than Wall Street was modeling. You know, in this high inflation environment where input costs are a constant battle, beating on the bottom line like this is a sign of some serious operational discipline. We can consider this a solid piece of rebar in the company's foundation.
But not so fast. Just as they were celebrating that EPS beat, the top line, the revenue, tells a very different and much less positive story. Revenue came in at $3.03 billion, missing expectations by almost $47 million. So let me get this straight. They're making more profit on less sales than expected? That, my friends, is what we call a low-quality beat. You simply cannot build a skyscraper on a shrinking plot of land. This immediately throws up a huge red flag for me. Is this genuine efficiency, or is there something else going on under the hood? This miss on the top line suggests there's a crack forming right at the base of the structure.
And that crack leads us directly to our next area of inspection. See, a company isn't just one single monolithic block. It's a complex structure made up of different parts, different divisions. We have to look at the performance of Hormel's core segments, that's retail, food service, and international, to really understand where the strength is and, maybe more importantly, where the weakness is hiding. So let's crack this thing open and see what's inside. Let's start with the good news, because there is some serious strength here to talk about. The food service segment, this is the part of the business that sells to restaurants, hospitals, schools, you name it, is on fire. Organic net sales are up a very healthy 7%. And this isn't some one-off good quarter. This is the 10th consecutive quarter of growth. Think about that. That is a massive, solid steel pillar supporting the entire company. It shows that their products are in high demand with professional operators, the people who need quality and reliability day in and day out. This segment is an absolute powerhouse. And it's not the only one. Let's shift our focus to the international segment. This is another power pillar. Organic net sales here are up 8%, and a lot of that is being driven by their iconic brands like Spam. This shows us that this isn't just a domestic success story. Hormel is executing on a global scale. They're seeing strong performance in places like China and with their branded exports, which shows their strategy is working and their brands have real, durable global appeal. So far, we're looking at two incredibly strong supports holding this whole company up.
But hold on. While you're admiring the view from those two strong towers, the foundation of their largest segment is literally crumbling. The retail segment, these are the products you and I buy in the grocery store, saw its profit plummet by a staggering 19%. Let that sink in. This isn't a small leak we're talking about, this is the basement flooding. A nearly 20% drop in profitability for their biggest division is a massive structural failure, and it threatens the integrity of the whole building.
And this table right here just brilliantly illustrates the divide inside this company. Just look at the data. Foodservice and international are posting fantastic double-digit profit growth, 13% and 10% respectively. I mean, they are the engines of this company right now. But then you have retail, volume down 6%, sales down 2%, and that profit just collapsing by 19%. This is the absolute core of our stress test. You've got these two solid steel beams doing all the heavy lifting, while the single largest pillar, retail, looks like it's made of rotting wood. The critical question for any investor is, can the strong parts continue to hold up the weak one indefinitely?
So why is retail crumbling? Well, it's not just one thing. They're getting hit from all sides. Part of it, to be fair, is strategic. They're getting out of some low-margin private label businesses. You can argue that's a smart long-term move, but it still hurts the top line right now. But the bigger issues are much more fundamental. They're seeing declines in key deli items. And more importantly, their costs are just exploding. Raw material costs for beef and pork are way up, and on top of that, they got hit with unexpectedly higher logistics and freight expenses. This isn't a small issue. This is a full frontal assault on their margins in their most important segment.
So when part of your structure is failing, you really have two choices. You can either try to reinforce it, or you can demolish it and rebuild something stronger. And from the looks of it, Hormel is choosing demolition. Management is actively reshaping the company's portfolio, cutting away businesses they see as weak or too volatile. Now, they call it a strategic move to strengthen the core. Let's dig in and see if it's a real reinforcement or if it's just a cosmetic fix.
The two big moves they've made are the sale of their whole bird turkey business and finalizing the divestiture of the Justin's brand. These are not small adjustments. The turkey business, in particular, is a legacy operation that is highly exposed to the wild swings of commodity prices. By selling it, management is making a very clear statement. They're moving away from volatile, commodity-driven products to focus on their higher-margin, value-added brands. It's a deliberate and pretty significant strategic shift.
And here's the logic, directly from the president of Hormel Foods, John Gingo. He says this is all about focusing resources on high-growth opportunities and reducing their exposure to volatile commodity markets. This is the classic defensive playbook. When you can't control the price of your raw materials, you get out of that business and you double down on areas where your brand gives you pricing power. It's a perfectly logical move to de-risk the company and try to stabilize those long-term margins.
But let's be skeptical here for a moment. Is this truly a visionary strategic pivot, or are they just cutting loose underperforming assets to make the overall numbers look better in the short term? I mean, think about it. Getting rid of a low-margin, volatile business will almost always boost your company's average margins. That's just math. The real question is whether the in column, that focus on value-added products, can actually generate enough new growth to make up for the assets they're selling off. This could be a really smart move to build a stronger, more profitable structure, or it could just be hiding the ugly parts of the building behind some new drywall.
This leads us directly to the blueprint for the future, management's forward guidance. This is the part where they tell us what they expect to build for the rest of the year. So, what does the outlook signal? Is it real confidence in a stronger future, or are they just planning to maintain the status quo and patch a few holes along the way? The guidance is really where the rubber meets the road.
Okay, so on the surface, this looks good. The company is raising its full-year GAAP EPS guidance. They've bumped the range up pretty significantly. It's like the architects are looking at their plans and telling investors they expect to build a more profitable structure by the end of the year than they previously thought. This is a clear signal of confidence, and it's often driven by better-than-expected performance or more favorable outlook.
Whoa, pump the brakes. Let's look at the numbers they really want you to focus on. The adjusted guidance. The adjusted diluted EPS range? Unchanged. The organic net sales growth forecast? Unchanged.
So what you're seeing in that gap update is almost entirely accounting noise. It's from the one-time gain on the sale of the Justin's business. It is not from improved operational performance. They're not actually expecting the core business to perform any better than they did 3 months ago. This feels less like a confident forecast and a lot more like they're just shuffling numbers around to maintain appearances.
And while they're just holding the line on that guidance, the external pressures are building. This structure is facing a storm. Pork trim costs are up 12% year over year. Beef costs remain elevated, and now they're getting hit by unexpectedly higher logistics costs, thanks to severe weather and tight freight capacity. These are not small headwinds. This is a sustained gale force wind that is pushing against their profitability, especially in that already weak retail segment.
All right, we've run the stress test. We've examined the blueprints, we've hammered on the beams, and we've inspected all the cracks. It's time to weigh all the evidence and deliver the final assessment. Based on this full structural analysis, is Hormel Foods an opportunity for your portfolio, or is it a trap just waiting to spring? It's time for the iron verdict.
So let's break down the final blueprint. On the one hand, you have these two pillars of solid steel. The Foodservice and international segments are powerful, they're growing, and they're profitable. They provide a robust, load-bearing base for the entire company. And you have to give management credit. They're making what look like the right moves with their portfolio reshaping. It's a logical, smart strategy to get rid of volatile, low-margin assets. But you simply cannot ignore the foundational crack. The retail segment is their largest, and it's showing deep, persistent weakness. Its profits are collapsing under the weight of lower volumes and higher costs. And they're trying to do renovations, but they're doing them in the middle of a hurricane. The external headwinds from commodity inflation and logistics costs are applying constant, unrelenting pressure to the entire structure.
So the final verdict really comes down to this single, critical question. Hormel is in the middle of a massive renovation project. They're demolishing parts of their old, shaky structure in an attempt to forge a new, stronger foundation. It's a bold plan, and you could argue it's a necessary one. But the ultimate question for any investor remains: can this new, leaner framework truly support long-term profitable growth, or will the cracks in their massive retail base, combined with the storm of external pressures, prove too deep to repair? That is the decision you have to make. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.